Hi, this is Sylvia from IFRSbox.com, and let's take a look to standard IAS 18 that deals with the revenue recognition. IAS 18 undergoes major revision, and therefore we will look at its current development first. IAS 18 was originally issued in 1982, and then it was significantly revised in 1993 as a part of Comparability of Financial Statements project. Since then, there was no major change in the standard for many years. But there is a convergence project in place between International Accounting Standards Board, who is setter of IFRS, and the Financial Accounting Standards Board, who is setter of American Standards US GAAP. These two organizations work together as a team in order to bring IFRS and US GAAP as close as possible. And one part of this convergence project is also amendment of IAS 18, because there are significant differences in revenue recognition between IFRS and US GAAP. So in 2011, IASB issued the first exposure draft related to IAS 18. And this would eventually be the new IAS 18 standard, and its main objectives are to remove inconsistencies and weaknesses in existing revenue requirements, to provide more robust framework for addressing revenue issues, to improve comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets, to improve disclosure requirements, and to simplify the preparation of the new financial statements. New IAS 18 will be obligatory to apply for the period starting 1st January 2017, so there is still a lot of time left for the current version of IAS 18. And let me also say that the earlier adoption of IAS 18 will not be permitted. So the existing version of IAS 18 will be applicable for all periods starting 31st December 2016 or earlier. So what is the revenue? It is a gross inflow of economic benefits during the period arising in the course of ordinary activities of an entity. Ordinary activities mean basically sale of goods, rendering services, receiving interest, royalties, or dividends. Revenue causes increase in equity but other than from equity participants. So if shareholders decide to provide more cash to their company by increasing share capital or other reserves, it is not revenue. Now, let me draft one very often and difficult issue when deciding whether certain income is revenue or not. I'm referring to so-called agency relationships. So what is agency relationship? Instead of two parties in the transaction, which is buyer and seller, we have three parties in agency relationship. Well, there is a principal who is in fact providing the goods or services and is responsible for them. Then there is an agent who acts on behalf of a principal and sells the goods or services, just as an example, right? And the third party is, of course, the customer. The agency relationships are very common in telecom industry, and often it's not clear whether there is or is not the agency relationship. In agency relationships, the principal recognizes the revenue and the agent does not. Instead, agent recognizes just revenue from commission earned. IAS 18 gives us a guidance to determine the existence of agency relationship. There are 4 criteria that indicate that an entity is acting as a principal. The first one, the entity has a primary responsibility for providing the goods or services to the customer or for fulfilling the order. The second one, the entity has inventory risk before or after the customer order, during shipping or return. The third criterion, the entity has latitude in establishing prices either directly or indirectly, for example by providing additional goods or services. And the fourth criterion is that the entity bears the customer's credit risk on the receivable due from customer. So just as an example, if telecom operators sell some content like music or applications together with their monthly plans, then can the operator recognize revenue from selling that content? Well, it depends. If the content is an own brand product or service, then the revenue receivable from subscribers should be recorded as revenue by the operator and the amounts payable to the third party or content creator as costs. But if the content is a non-branded product or service that is merely using the mobile operator's network as a medium to access its subscriber base, then the amounts receivable from subscribers should not be recognized as revenue. Instead, only the amount of commission can be reported as the revenue. So be careful, mainly in telecom industry, as it's the most critical area of services with agency sales. Each transaction must be carefully assessed. Now, let's take a look on the revenue measurement. The revenue should be measured at fair value of consideration received or receivable. In most cases, fair value is simply cash received or receivable, as it would be stated in an agreement between two parties of transaction. Of course, trade discounts and rebates should be deducted. But in some cases, cash might not be paid immediately and in full amount, but postponed to the future or spread into some installments. Sometimes the transaction would include something similar to loan or other financing arrangement, and in this case, it is necessary to discount future cash flows by imputed interest rate to present value. When goods or services are exchanged for other goods or services, the revenue recognized from such barters would be just fair value of goods received. And if the transaction involved also some cash, then the revenue must be adjusted. However, if goods or services exchanged have similar nature, revenue cannot be recognized, as this is regarded as transaction non-revenue generating. Let's now talk about the general rule of revenue recognition. Revenue shall be basically recognized as earned at the point of sale, because at that point usually 4 criteria will be met. The first one, the product or service has been provided to the buyer. The second one, the buyer has recognized the liability to pay for the goods or services provided. And on the other hand, the seller has recognized that ownership of goods has passed to the buyer. The third one, the buyer has indicated his willingness to hand over cash or some other asset to settle the liability. And the fourth one, the monetary value of the goods or services has been established. So those are just general criteria for the recognition, but there could be exceptions. For example, recognition of profit on long-term construction contracts in line with IAS 11. Now, let's move to the first main category of revenue, sales of goods. Revenue from sales of goods can be recognized when 5 conditions are fulfilled. The first one is that the seller has transferred significant risks and rewards of ownership to the buyer. The second condition for recognizing revenue is that the entity retains neither continuing managerial involvement that is usually associated with ownership, nor effective control over the goods sold. The third condition is that the amounts of revenue can be measured reliably. The fourth condition is that it is probable that the economic benefits associated with the transaction will flow to the entity. And the fifth condition is that the costs incurred or to be incurred in respect of the transaction can be measured reliably. IAS 18 provides a guidance on revenue recognition for certain specific circumstances at sale of goods, such as bill and hold sales. Well, here the revenue should be recognized basically when the buyer takes title. Goods might be shipped subject to various conditions, such as after completing installation and inspection, on approval with limited right of return or cash on delivery. Here the revenue shall be recognized basically when conditions are fulfilled. Layaway sales, here the revenue is recognized when the delivery is made. Sale and repurchase agreements, where the seller agrees to purchase the same goods back at the later date. Well, these situations are often just hidden financing arrangements and no revenue is recognized, but of course it needs careful assessment of the terms of transaction. Subscriptions to publications and similar items, well, the revenue is recognized in accordance with the period over which the items are dispatched. Another category of revenue-generating scenarios is rendering of services. Well, it's slightly more complex area than sales of goods because services are intangible in their substance. And therefore, the principal question for revenue recognition when rendering services is whether the outcome of transaction can be reliably estimated. If yes, then the revenue might be recognized based on the stage of completion of the transaction at the end of reporting period. If the answer is no, then another question arises: are expenses already incurred recoverable? If yes, then revenue can be recognized in amount of recoverable expenses. If not, the revenue cannot be recognized and costs already incurred would be just recognized as expenses. But when can the outcome of transaction be estimated reliably? First of all, amount of revenue can be measured reliably. Second, it is probable that economic benefits associated with the transaction will flow to the entity. Third, the stage of completion at the end of the reporting period can be measured reliably. And fourth, the costs already incurred and cost to complete the transaction can be measured reliably. Standard IAS 18 gives us a guidance on revenue recognition for the specific types of services. Installation fees are usually recognized as revenue depending on the stage of completion, well, mainly if the installation is complex and long-lasting, of course with some exceptions. Services fees included in the price of the product, like some sales support or software upgrades after its sale. Well, if the amount for the subsequent services can be identified by the seller, it should be deferred and recognized as revenue over the period in which the service is provided. Advertising commissions. Well, here media commissions are recognized when related advertisement of commercial appears before the public, and production commissions for marketing and similar campaigns are recognized by reference to the stage of the completion. Insurance agency commissions. Here, if agent is required to provide further services, then the revenue from commissions should be deferred over the period during which the policy is in force. If the agent is not required to provide further services, then revenue can be recognized at the date of policy commencement or renewal. Fairly complex area represents a wide range of financial services. Broadly speaking, recognition of revenues for financial services depends on the purpose for which the fees are charged and the basis of accounting for associated financial instrument. For example, some fees might represent an integral part of the effective interest rate of a financial instrument, and therefore are recognized as an adjustment to the effective interest rate, while some fees are earned immediately on the completion of some act or as services are provided, like allotment of shares or fees for managing of the investment portfolio. Revenue from artistic performances or other special events is recognized when the event takes place, but when subscription to a number of events is sold, then the fee is allocated to each event on proportional basis. Tuition fees for educational or similar services are recognized over the period of instruction. Initiation, entrance, and membership fees, well, if fee permits only membership and everything else is paid separately, or indicates of separate annual subscription, fee is recognized as revenue immediately when membership starts. But if the fee entitles members for any services, publications, drinks, meals, or anything else during the membership period, then the subscription must be deferred. Franchise fees, well, they may cover a broad range of services or equipment to supply, and therefore revenue is recognized on the basis reflecting the purpose for which fees were charged. Well, but here, be careful, because when fees are charged for certain initial and subsequent services, well, revenue is recognized when the services are provided, and when initial fee includes also provision of continuing services, then revenue must be deferred. Careful here, because if the separate fees for continuing services do not cover cost for continuing services plus some reasonable profit, then part of initial fee must be deferred. Let me also mention fees from development of customized software. Here, IFRSs do not address all issues related to software revenue recognition, such as recognizing revenue from data services, customer support services, software licensing fees, and other. So some companies use US GAAP as guidance, while IFRS only says that the basic rule is to recognize the revenue based on the stage of completion of development. And if the contract price includes also some portion of post-delivery service support, calculation of stage of development must take into account also this phase. The last category of revenue-generating scenarios covered by IAS 18 comes from utilization of entities' own assets by others and receiving interest, dividends, and royalties in return. There are two basic conditions for revenue recognition of these revenues. It is probable that economic benefits associated with transaction will flow to the entity, and the second, the amount of revenue can be measured reliably. These two conditions apply for all three types of such revenue. Interest income shall be recognized using effective interest method, as stipulated by IAS 39 or IFRS 9. Royalties may be paid for the use of trademark, patent, software, music copyrights, record masters, or motion picture films, and they shall be recognized on an accrual basis in accordance with substance of relevant agreement, usually on a straight-line basis over the life of agreement. Dividends shall be recognized when the shareholder's right to receive payment is established. Except for all these rules on revenue recognition mentioned in this summary, IASB issued several interpretations dealing with some specific areas of revenue-generating scenarios, for example, IFRS 13, customer loyalty programs. Don't forget to visit our website ifrsbox.com, subscribe and get many free Excel files, articles, news and other IFRS things. Bye bye and thank you for watching.